It's our week 6 introduction video for financial statement analysis and funding expansion or financial forecasting. That's our topic this week for week number 6. There is no graded assignment this week. You posted case number 2 last weekend. I'm working on the grades right now, and they'll be posted by the end of the week and reviewed in my weekend update video. Also in that weekend update video, I will begin the first installment of a review for the Electrics Incorporated case. I will put together a checklist of things you need to do to complete that case assessment paper, and that'll be in my weekend video. One of your tasks this week in this non-grading week is to download the material for the Electrics case and read it. See what it's all about. Begin to think about and piece together your plan to complete that work. But our subject at hand this week is chapters 3 and 12, kind of an odd mix of chapters, but it makes sense. Both of them involving financial statements. And one of the key parts of corporate strategy, once you complete an investment goal or make an investment in an asset, is understand what those investments have produced as far as profit, cash flow. How is your company trending in its analysis compared to the market and the industry that you're in? This is our subject this week in chapters 3 and 12. The material this week will be a part of our case number 3, which will be posted this coming weekend on Sunday night and due December 11th. This will be part of that case number 3, where you'll be doing a PowerPoint analysis of the company that you have selected in this class. So again, some more work with that company you've been doing work on in other cases in this class. So let's take a look at chapters 3 and 12. But before that, let's make sure we are up to speed on where everything is in our Blackboard. I hope everybody came out of the holiday Thanksgiving weekend safe and secure and healthy. A lot of flu and colds going around. And I know back on the Laverne campus, which you guys are not participating in since you're online, we're beginning to start wearing masks again in the classroom, just to be on the safe side. A lot of students have the cold and flu, not COVID, cold and flu. So just be careful. And as we wind down our course, this is week 6. This is an 8-week class. Here's where we stand as far as our timeline is concerned. We have case number 3, which we posted this weekend, due December 11th. And then the course assessment case paper, which is the Electrics case, which has been posted, and it's due the last day of our class, December 18th. That technically is our final examination for this course, that course assessment case paper. More on that in my weekend video in a few days. And we are now on week number 6. So here's that status. Here's the spreadsheet that I'll be reviewing in my lecture tonight. It's called Financial Statement Analysis, Week 6 Lecture Review. So if you would like to follow along and download that, please feel free to do so. It gives us nice little definitions. Now, I assume by this point in your academic training and your business career, you pretty well know what an income statement is, what a balance sheet is, and what a cash flow statement is. We're going to be taking a look at it in regards to strategic meanings of these 3 statements and how they help us plan on what's happened, looking for trends in our business, and secondly, where we can forecast into the future about using our financial statement information. 2 important strategic items for an MBA student. So let's take a look at this spreadsheet. Oh, before I get to that, excuse me, a little bit farther down are 3 articles: Restoring Trust After the Bubble, a model for effective financial analysis, and an article analysis of financial statements. Please, if you can have the time, please have the time in the next week or so to download these and read these articles. They will be a part of our case number 3 next week in regards to looking at financial statement data. So take a look at those articles. They might be of some good reference for that case coming up, case number 3. Now let's take a look at that spreadsheet. One of the key things in financial management is to make decisions about financing. Naturally, how do you finance the investment in assets, how you fund those assets, but all at the same time, how you make those decisions of funding assets and expanding your business and making it more profitable and more efficient is understanding what your financials tell you about. It's like a report card for your business. Are you making the right strategic decisions? Are you making a profit? And understanding what this information tells you. Remember, financial statements serve two purposes. Internally, they tell management, they tell inside the company how your strategic policies are doing. How's your business plan doing? And secondly, they serve as a way of public relations, letting the world know how you're doing. And who's the world? Your investors, your competitors, potential investors, and naturally also the government. So financial statements serve two purposes. In this class, it serves the purpose of giving us internal direction of how our strategic goals are going. So here we have a series of tabs in this spreadsheet about what it tells us about a company. The balance sheet, which tells us on a given day, December 31st in this case, what's our asset position made up of current assets, which are considered liquid assets, and long-term assets, which are considered fixed assets or plant and equipment, and the liabilities of the company, short-term liabilities and long-term liabilities, and the equity position of the company. Equity meaning stock and retained earnings. Equity position for many companies can also mean treasury stock, can also mean preferred stock, can also mean paid in capital. But for this business specifically, it's just common stock and retained earnings. These are the assets, 3.5 million, and these are the liabilities and equity, 3.5 million. That's a statement of wealth of a company. It's the capital structure of a company. Very important sheet, the balance sheet. Then we have below it the income statement. This is for a period of time, 12 months. And during those 12 months, what were the sales of the company? What were their expenses, cost of goods sold, other expenses, depreciation? What was their operating margin, their earnings before interest and taxes? What were their interest expenses on debt that they have incurred? What was their earnings before taxes? And then their taxes, paying the federal and state government. In this case, the company had a 40% tax rate. And then bottom line, what was their net income? As you can see here in 2020, they lost money. In 2021, they made a profit. And then they also give us the dividends that the company paid out. Remember, in accounting, the income statement is a temporary financial statement. It lasts for 1 year and then it all zeroes out and you begin a new year. Whereas the balance sheet continues over and over, on and on, as long as the company is operating. So you always have a balance sheet year in and year out. You always have an income statement year in, year out, hopefully. But the income statement is zeroed out at the end of every year. And where is it zeroed out? Retained earnings. Notice if I take a look at the deltas between 2020 and 2021 on this financial statement, and this is a real company, by the way, just the names have been changed to protect the innocent. Notice the delta of retained earnings from 2020 to 21 is $198,584. Well, where'd that number come from? Well, it came from closing the books of the income statement. Notice the company made a profit of $253,584. And notice they paid 22 cents a share in dividends on 250,000 shares of outstanding stock. 250,000 shares of stock times 22 cents a share is $55,000. So if I take $253,584, our net income, and I subtract out the dividends of 55,000, I get the delta in retained earnings of 198,584. Because when this company, their accountants closed the books, they zeroed out all the revenue, expense, and dividend account to retained earnings. And that money is carried forward into the cycle year after year of the business. It's a source of equity. The amount of profits we retained every year is accumulated in the retained earnings account. That's one important highlight of the accounting side of financial statements is it's the ongoing statement is the balance sheet. The temporary statement is the income statement. And that leads us into the cash flow statement. If you look at the balance sheet, notice the delta between cash and equivalents from 2020 to 2021 was $6,718. What made up that $6,718? What kind of cash did come into the business and what kind of cash went out of the business? Well, this is very important for financial managers and corporate strategists. Where are we generating cash and are we generating enough of it? Well, they're generating enough of it, but not by much. $6,718 of net new cash came into the business in 2021. And where did that come from? Well, it came from all the deltas of the balance sheet accounts and the income statement. Put all those together and you get $6,718. And in the cash flow statement, it's put into three categories to aid the internal managers of understanding where this money came from. The operating cash flow, the financing cash flow, and the investing cash flow. And if you notice here, we had negative cash flow in operations and negative cash flow in investing. Now, negative cash flow in investing is usually the case. You're spending money on assets, you're growing the company, you're investing in new assets. That makes sense. But having negative cash in operations, that's a tough nut to swallow. Why? You should be generating positive cash flow with your net income, your depreciation, your borrowing short term. Those are all positive cash flows. But notice in this company, they got a problem. And we'll go back to the balance sheet to see that. Their accounts receivable balances increased by $246,000 in 2021. Their inventories increased by $429,000. That is considered negative cash flow. Why? Because we sold some sales on billed sales and we haven't collected the money yet. We produced inventory for sale and we haven't sold it yet. That's negative cash flow. And that's why this sticks out like a sore thumb in the operating cash flow statement as almost $700,000 of negative cash flow from operations. Hopefully that's not a continuing trend for this company. So negative cash flow in operations, negative cash flow in investing. So the company had to generate some additional cash to make up for these deficits. Where did it come from? Very simply, they issued more stock. And as you all know from your study up to this point in this class, issuing stock, the cost of equity, is the most expensive form of financing. And what did they do with this? Well, let's go back to the financial statements. Notice at the very top, in 2020, they had 100,000 shares of stock. In 2021, they had 250,000 shares of stock. So they increased their stock position in the market by 150,000. That generated $1.22 million of additional cash coming into the business. They issued 150,000 more shares of stock. That's additional cash coming in. That's fine. But now instead of 100,000 shareholders to worry about, you got 250,000 shareholders to pay dividends to make sure that stock price of your company goes up year after year, quarter after quarter. Very expensive to keep those people happy. You have to invest, grow, gain market share, Can this company do that? That's the big question of the night that they have to decide. So with all that cash coming in right here as common stock, what did they do with some of that money? Well, it looks like they paid off some debt, paid off note payable, reducing the note payable balance by 420,000, and they paid off long-term bonds, reducing that by 500,000. So they took some of that money and it helped out the deficits in operations and investing, but also it helped out paying off some of their old debt. It's an expensive way to pay off debt. Usually you want to have your cash flow from your operations helping you to pay off old money. Here they're taking new money to pay off old money. Not good. And at the same time, they also had a deficit of $55,000 of cash as dividends. So they had a positive cash flow of 245,936 after they sold those 150,000 shares of stock to the market, paid off some old debt, paid off dividends, met the obligations of operating and investing cash flow or negative cash flow, and they're left, voila, with $6,718. Exactly what the delta is between cash for 2020 and 2021. That's the big three financial statements. That's what they tell us. Our statement of wealth on a given day, our recording of sales and expenses for a given period of time, and the flow and inflow and outflow of cash for a period of time. All this information tells managers, tells corporate strategists, are their investment in assets paying off? In some respects with this company, they are. In other respects, they're not. Thus, the challenges of operating a business. A couple other things that are important to know as a corporate finance student is free cash flow. You see that a lot. What is the cash flow available to investors or to the company after they met the obligations of operating the business? How much cash do they have left over? And from Warren Buffett to Jamie Dimon to all leading bankers and investors around the world, free cash flow is a key indicator of a company's performance. Are they generating enough extra cash after they've ran the business? Do they have anything left over to invest in new projects and new markets? As you can see here, they ain't doing it. Negative $146,304 in negative free cash flow. Now, I'm not being concerned about how this number is calculated with you. At this level of study, you've probably already studied that, but understanding that free cash flow is a measure of corporate performance. Are they generating additional cash to invest? Invest in new businesses, invest in new markets, new strategies. This company is not doing it. That's an important definition of another type of financial indicator, free cash flow. But the most important financial indicators are financial statement analysis. What are the trends in a business in relationship to trends within their business and also trends according to the industry or the competitors that they are in? Remember, one of the advantages of being a public corporation is that you can see the performance of your competitors. How are they doing? What are they trending? Are they making money? Because everybody has to publish these to the market. One of the most important things that happened in Wall Street every quarter is the investor calls. Every quarter, the CFO of a company produces this information to the market. Financial statements, analysis, reports, trends. Every quarter. And every quarter, the market reacts. Maybe some buy more stock, some sell stock, maybe some sell stock and invest in competitors because they're doing better, whatever. But this is the advantages of public corporations. Everybody can see their data. The Form 10K is an important statement in financial circles. That's the 10K statement every year of all the operations of a business. So here I've isolated 6 key ratios, and these key ratios you're going to work on as part of your case number 3 next week. The current ratio, which is a liquidity ratio, the relationship to current assets to current liabilities. The debt ratio, which is a debt management ratio, which is current total debt into total assets of the company. The profit margin on sales, which is a profitability relationship of net income to sales. The return on total assets, which is the relationship of profitability to assets of the company. Skip one over, the earnings per share, which you see this all the time in business, and we've done some work on. Earnings per share is the relationship of net income to shares of stock outstanding. And using that earnings per share to determine the price earnings ratio, which shows the market relationship of what the market says your stock is worth in accordance to what the earnings per share are generating off that stock. In your Blackboard, and I'm going to show you that in just a minute. Let me stop right here. In week 6, there's another file that I would like you to look at in correlation to those articles that I was talking about. It's right here, the financial statement analysis PDF. And why is that important? Because of this. It's taken from the textbook and it shows the key financial indicators of business. Profitability indicators, asset management, liquidity, and debt management. And those 6 that I just talked about in that spreadsheet are taken from here. All examples of those analysis. And they tell us something about a company. It's kind of like opening up the hood of a car. You open up a hood of a car and you want to see what the engine looks like. How's it sounding? How's it running? Is it healthy? These tell you whether an industry or a company is healthy, how they're running. Very important indicators for management and outside of management. So that's what we're doing here with this second tab. The current ratio is current assets divided by current liabilities. In 2020, it was 1.46. So for every $1.46 of current assets, there was $1 of current liabilities. In 2021, oops, let's do this here. Get that out of there. So what is the current ratio for 2021? If I take the current assets of 2021, which is 2,680,112, and divided by the current liabilities of 2021, 1,039,800. Don't forget to put in an equal sign, Mr. Hassey. There we go. It's 2.58. The industry average for this industry that this company is in is 1.25 to 1. Well, 2.58 is a little ugly. And we know the answer of that. Remember, we talked about earlier, the high amount of receivables and inventories in this company's balance sheet. That's creating a little bit of, remember, this ratio or this relationship is for liquidity. It's also for efficiency. And the current standards in most business is about 1.25 to 1. This is way too high for this company, showing some problems with receivables and inventory. The debt ratio, it's the relationship of total debt, which in this company, the total liabilities are 1,539,800. And divide that by the assets of the company, 3,516,952 in 2021. Turn that into a percent. 2 decimal points as always. 43.78% is our debt ratio, and that's pretty manageable. Notice the industry average is 65%. And why did that dramatically go down from the prior year? Well, remember on the cash flow statement, we paid off $920,000 of debt with that stock sale. So we cleaned up our balance sheet a little bit, but we also created some more problems, as we talked about earlier, with that high amount of equity demand by the market and the demand that they will cause the company. But at the same time, we've cleaned up our balance sheet to be a little bit less leveraged. Our debt managed situation is a little bit better. So on one hand, we did good. On the other hand, we've created another problem area. Welcome to the world. The profit margin is the relationship of net income. In this case, it was 253, 584. And divide that by the sales of the company in 2021, $7,035,600. Put that into a percent, 2 decimal places, as always, 3.6% profitability. That's our profit margin. For every dollar of sales, we're making 3.6 cents. Okay. The industry average here is 5%. We're not making as much money as our competitors. That should be a concern, especially since the year before in 2020, we lost money. The return on total assets is the relationship of net income, 253, 584, divided by the assets of the company, 3,516,952. Make that a percent, 2 decimal places, 7.21. Again, filling the same lines that we're not making enough profit. 7.21 is okay, but the industry average for this company is 9.5%. We're not making enough profit off the assets that are generating those profits. Our earnings per share, well, as we said earlier, it's the net income of the company, 253, 584, divided by the number of shares of stock outstanding. And in 2021, there were 250,000 shares of stock. So a little bit over a dollar. Let's make that into dollars. $1 and a penny earnings per share, which isn't bad. And then the financial statements tell us that the stock price on December 31st was $12.17 in the market. So our PE ratio is the relationship of that $12.17 divided by the earnings per share. And we'll make that 2 decimals. So the stock price in the market is 12 times greater than the earnings per share. And that's pretty competitive. As you can see, the market, the industry is 13. You don't want to get that PE ratio into 30s, 40s, or 50s. That means your stock is overvalued in the market, meaning the value of that stock in the market is not creating enough profit. And that can make investors a little leery about maybe it's time to sell that stock when it's overvalued. When the PE ratio is low in the single digits, that means the stock is cheap. It's not the stock price indicates there's some more profit out there to be had, and the market has yet to figure that out and increasing the value of the stock or the demand for stock in the market. It means maybe you should buy that stock because it's cheap. It's a low PE. One of the leading market indicators or logarithms to drive stock prices is the PE ratio. If the PE ratio hits a certain number, stocks are bought. If the PE ratio hits a certain number, stocks are sold. It's a key indicator for portfolio management in the market. But these indicators tell us the relationship of the company and trends, and many companies do this going out multiple years, even by quarters, 4 quarters in a year, seeing the trends within a year, and also comparing it to the industry, how their competitors doing. Because if all of a sudden you see your stock price dropping, maybe some of your investors are going to your competitors. That can be a source of problem. So this is statement analysis, a very key indicator for financial strategic purposes, how we are doing trending wise and comparable to our competitors. And the final tab of this spreadsheet is how do we take financial statements, here's our financial statements again, and predict what we're going to need for capital in the future. Okay? Using our current financial affairs and what do we need to generate additional capital? Example, and I'll keep this very simple. Not in this case context of this business, but another example. Let's say I have a business and I want it to grow next year. Well, in order for my business to grow, I'm going to have to invest in new assets, new capital to create that growth. Where's that money going to come from? Well, the money is going to come from two sources. Internal sources, which are the profits of the company, and borrowing the money short term, current operating liabilities, accounts payable. You can fund your business by borrowing money for 30 days. Those are internal sources of capital, profits and operating liabilities, short-term liabilities. But then there's external sources, and these are expensive. Remember, internal sources are no interest, and it's your own money. It's cheap. External sources are expensive when you have money or borrowing money long-term, interest, and when you buy and issue stock, very expensive. So a company, when they're trying to project out their needs in the future, remember, well-run businesses strategically don't really pay attention to today. They pay attention to the future. What are they doing 1 year, 2 years, 3 years out to make sure they stay competitive and have efficient products in the future? Companies that do not do that are not going to be lasting very long. So here's an analysis. It's called the AFN analysis. It's a typical capital forecasting analysis. This is taken from chapter 12. And I'm not, to be honest with you, I'm not going to be asking about any of this analysis in your case number 3. But it's good as a MBA student in corporate finance to understand the concept of how do I predict what are my capital needs going forward in the future. And the AFN analysis is one of the popular models to do that. So in this case, we're taking a look at these financial statements of this company that we're spending time on this spreadsheet. And as you can see, we're looking at 2021, and that's the numbers here, 2021. And we're projecting out into 2022. What are our capital requirements going to be to grow? In this case, the company wants to grow 15%. They want a 15% increase in sales. So let's say they're at 100% asset use. They're getting all the use they are out of the current assets of $3.5 million. So in other words, to increase sales by 15%, the model says we got to increase assets by 15%, which means a $527,000 investment in additional assets to generate a growth rate of 15%. Where is that money going to come from? Well, first of all, let's look at our internal sources. If we have current operating liabilities in 2021, of which are only accounts payable and accruals, notes payable is interest-bearing debt, so that is not considered an internal source because it's capital interest. So the total of accounts payable and accruals is $739,800. If we increase that by assuming 15%, we're going to be generating $110,970 of operating liabilities to help us pick up the tab for part of that asset growth. We'll use short-term debt, 30-day debt, to fund part of that $527,000. So let's say we're projecting a 15% increase in sales. And notice, what is our profit margin in 2021? Remember, we determined our profit margin was 3.6%. Let's say the company is projecting we want to maintain that 3.6% profit margin in the coming year. All right. Well, if our sales and our profits increase by 15%, here's our sales of 2021. If they increase by 15% per our projections, that means a $1,055,000 increase in our sales. If we take 3.6% of that, we're anticipating a $291,622 profit in 2022 based on those projections. Remember, the key thing here is projections. So if let's say we want to maintain our dividend payout for next year, right? Remember, we paid out 22 cents a share in dividends. That was a dividend payout rate of 21.69%. In other words, we paid out $55,000. Let's go back here and I'll show you. We paid back $55,000 of dividends. That was 21% of our total net income. That's our dividend payout rate. So we want to maintain that payout rate in 2022 of 21.69%. So if we take 21.69% of our profit projected, that's $63,250 in dividends we're projecting in 2022. That lets us or has us remaining $228,372 of profits that we can use to fund our asset growth if we so choose. We need 527 to increase assets to increase our sales by 15%. 110,000 of that 527 is coming from operating liability or short-term debt. 228,000 is coming from our profits that we're going to use to fund part of this. And the difference between assets, delta, current operating liabilities, and retained profits is our AFN, $188,201. In other words, 188,201 plus 228,372 plus 110,970 equals 527,543. So we're going to generate this need to raise $188,201 by either borrowing more money long term or interest bearing debt or issuing new stock. That's the strategic decision that this company has to do for 2022 if they want to increase their business by 15%. They got to go out and find new money. And that's the bottom line. Can they do that? But then there's different strategies that you can do. Let's say I decide not to pay a dividend next year. I don't know if the shareholders are going to go for that, but let's say we wipe out that 63,250 and use all of our profit to fund our growth. That leaves us with an AFN of 124,951. Another strategy would say, you know what? We're biting off more than we can chew with this 15% increase. Let's only increase 7%. Then we will have plenty of money to fund that asset growth. So these are the strategies that a lot of MBA finance people do at companies. They take a look at their financial statements and they project out 1 year, 2 years, 3 years, and they use models to determine what type of external demands on their cash are going to be needed to make these things happen. In this case, $188,201 of external cash they need to go out and raise to meet their 15% goal. Why a 15% goal? Maybe they're under pressure from investors. You know, you guys got to start kicking some butt and get some market share and start making some more money. All right. This is what we have to do in order to make those goals. It's called financial capital forecasting. And it's using existing financial data to produce or to project into the future. So in case number 3 next week, you're going to be looking at the financial statements of your company that you've been looking at throughout this course, and you'll be doing some analysis of their financial statements. And then you're going to be doing some strategic decision or strategic interpretation of this information and putting it into a PowerPoint format. Plus, there'll be some under questions related to the articles you're reading this week. Well, that's what case number 3 is next week. So it's been a while since you've studied accounting and financial statements, review this material. It will help you with case number 3. Do not worry about AFN analysis or capital forecasting analysis from chapter 12. But again, this is good to have in your little noggin in your brain for future reference, and understanding that this financial forecasting is a key ingredient in determining what needs I'm going to need going forward to raise money to increase my business growth. And all companies have to grow. Why? Because they have stockholders that want to keep making money. They want that stock price to keep going up. You got to grow, or being more efficient to do that. So that's our introduction lecture for this week, number 6, financial statement analysis. A key component of strategic thinking once you decide on where you're investing your assets, as like we did in the capital budgeting process. So at my weekend video at the end of this week, we will review case number 2 and the solutions of that case, the spreadsheet, which will help you start to begin the work of the electrics case, which is the second part of our weekend update video, to go over that case and help you start beginning the work on that. And also we'll introduce case number 3, the PowerPoint case, which is due December 11th. So that's where we stand right now. So I hope you have a good week, and we'll see you all in a couple of days. Take care and be safe. Adios.